Let's get chatting then about the global markets. Fook Hien Yap, Senior Investment Strategist at StanChart Bank, is now with us on the show. Thank you very much for joining in. You know, if you told anyone 12 or 18 months back that U.S. markets would see 500 basis points of rate hikes, and yet the U.S. GDP would grow at 2%, the jobs data would grow for 2.5 straight years in a row. Most economists, even the prominent ones, would have said that this is highly improbable. What have you made of the strength of the U.S. macro, and what does it mean for the 10-year yields going ahead and rate hikes?
Yeah, thanks very much for the question. You are right. I think coming to the end of last year, a lot of people looking at the yield curve inversions were already talking about the recessionary pressures. But we've seen the economic surprises have been positive, and in fact, surprised positively since the start of the year in the U.S. So ourselves as well, we used to think that a U.S. recession would be happening this year, towards the end of this year, but we've now pushed out our view into early, starting in Q1 of 2024. And I think a primary driver for that has been the U.S. consumers because of the pent-up savings from the pandemic. By some estimates, it went from 2 trillion down to about 1 trillion now. So they still have some excess savings that can use, and that's been keeping the economy stronger than expected. And I think by the same token, the U.S. market has been doing well in terms of how the data has been supporting it. And so that's really something that's been holding up the U.S. economy, and a surprise, as you say, because many in the street, ourselves included, thought a recession would happen this year. So the effect of that, we think, is that it's still going to be keeping equities in the U.S. supported, at least for the next 6 to 12 months. In our view, we have more of a neutral view. We see it as a core holding for us. But look, we've got a lot of key data points, right? We've got the CPI data this week, and that's going to be very live. The market is already expecting the Fed will be hiking 25 basis points later this month. But the CPI data is going to be quite key. It's a big driver, we think. And we've seen the expectations can change very rapidly. It's been a very volatile rates market. So that's something we're watching. Secondly, as well, is the earnings data, which is going to be coming out, and the expectations and how that will impact the corporate earnings outlook for 2023 and 2024. But look, to your question, I mean, it's pushing now at about 4% on the U.S. 10-year Treasury yields. We think your next kind of a resistance level is 4.08 and then 4.2%. Whether we get there, we think we will be dependent on the data. But we very much like the view of buying a long duration and long 10-year and equivalent high-grade government bond yield, because we think that we are coming towards the end of the Fed hiking cycle. And therefore, as yields drop, as we expect in 6 to 12 months, that's an opportunity because you get a capital gain on your high-grade government bond.
Got it. So, Fook, you're saying you've pushed out your U.S. recession expectations to Q1 of CY24, but you've not ruled it out completely, given how strong the U.S. economy is, correct? Got that. What about a market like India? We've been hitting new highs as well in the Indian market. Are you as sanguine about it? And do you think there's lots more to go towards the second half of the calendar year?
Well, we do like India. We think regionally, we think the whole Asia region, in fact, can outperform global equities. So within our equity allocation, we are asking investors and clients to rotate towards Asia. That's our preferred. Although, I mean, we are advocating to allocate broadly across China, India, even Korea and Taiwan and Japan as well. India has been amazing. We think the growth there has been great, especially in the small and mid caps. The revisions has been extremely strong since the start of the year. So the revisions in the earnings data for the small and mid cap has been good. So that's something we do favor. But overall, for the India market, it is pricey, but growth is very strong. We think it reflects that. But we do like the Asia region and India relative to global equities. And it's really in terms of the point of the cycle where we see growth still picking up in China and in India, whereas in the US and the Europe, we see policies there trying to slow down growth because of the worries about inflation.
Hi, Fook. Good morning. Nigel on this side. Fook, I think the last time you joined us, you told us on global equities you were neutral. Do you hold on to that view as well? And within the Asian markets, your pecking order, I think, was India, China, and Japan. Has that changed?
Yeah, we are still neutral on global equities. So our preference within the whole asset allocation space is really towards long duration, high grade government bonds. So within equities, we are neutral globally. In terms of the pecking order, though, we are advocating to allocate broadly. So at this point of time, there's no specific pecking order. We are talking about allocating broadly across India, China, Japan.
Got that. You have a great week, Fook. Thanks a lot for speaking to CNBC TV18. I always appreciate your thoughts. Keep it coming. Let's slip into a quick break on that note. On the other side of the break, plenty of stocks to start the week with. So don't go anywhere. We'll be back in a bit.